Hello there. It's Doc Severson for the ReadySetCrypto OMNIA Weekend Report for Sunday, May 31st. Now, I'm recording this early Sunday morning on the 31st, so there's about 12 hours to go in the day before we start printing more candles for not only the day, the week, but also the month. So we're going to start printing the next month's candles at 8 o'clock Eastern time tonight. Now, looking at Bitcoin versus the US dollar, about 3 weeks ago, we set up the expected move for the end of the month into May 29th. And you can see this probability curve has really set up nicely. So the price stayed well within the 68.2% probability envelope going forward into the end of the month. So we can get rid of that one and start to focus on the next one that we have. All right, so this is the one that we did a couple of weeks ago into the end of June, and it's right in the middle of that. Let's go ahead and update that. Now, based on what I just saw in Deribit, we have about a plus minus 1410 point expected move. So what this means is the upper end of the expected move is going to be set for about 11,000 or just under 11,000. So it's like 10,998. And the lower end of this is going to be 8178. So you can see that the expected move has come in quite a bit. So that's pretty close right around there. And then we'll bring in this probability curve into today. So that's the probability curve into the end of the month. You can tell just by looking at this probability curve that the implied volatility, the forward volatility, which is implied in the option chain, has come in. And this is because price hasn't gone anywhere. And so this is a natural reaction that I see all the time, is that when we get into a volatility coil like this, where the price doesn't go anywhere, people's forward expectations about this tend to go down. So people are just, they're creatures of habit, right? This is called recency bias, where we just think that whatever we've seen recently is going to carry on going forward. And we can verify this by looking at the skew. Let's go ahead and zoom in on this. And now what we're seeing is the implied volatility, especially over the last few days, has come in a lot. And we're almost back down to that level that we had before the asset crash that we had in early March. So this is important. And what this is saying is that the forward projected movement, according to the options traders out there, who are among the smartest ones out there, you can consider them the smart money, thinks that we're not going to see much of a move. Well, I disagree with that. I disagree with that assertion, because range contraction, especially range contraction that we see coming on decreasing volume, this is a classic pattern that we've seen over and over again. I mean, this is right out of a textbook that we're seeing this volatility coil with the volatility, the implied volatility coming in through the entire thing, the realized volatility coming in, the volume coming in on everything. This is typically where we see the biggest breakouts or biggest moves from. So what I'm saying is that, and this is consistent with what I said a week ago, is that I'm expecting to see a fairly big move either up or down from here. So we're going to see one of two things. We're going to either see some type of a breakout, and let's hope it's a valid breakout attempt. So in other words, a successful breakout attempt on good volume, which leads the price much higher and doesn't get pulled back down into the pattern. Or conversely, we could see a drop out of this pattern towards one of these three major fib retracements of the entire swing. Now, which way is it going to go? I don't know. I don't have any kind of view into the future. Typically, there is about a 70% probability that when we have a consolidation like this, the eventual breakout typically comes in the direction of the former trend. So from whence it came, typically 70% will go in that direction. So there's a probability attached to the breakout from this to the upside. However, that's a pretty big obstacle up there. Everybody can see this. Everybody sees 10,000. Everybody is lined up. There is overhead supply up there. That overhead supply can be turned against the bears, though, if all of a sudden they get put back on their heels and they have to cover all their positions. That adds buying power from them covering, and that is where the short squeeze comes from. So again, I don't know which way this is going to go from here. The other side of me says that when everybody sees the same thing like this, it tends to go in the opposite direction, just because too many people get levered up. Too many people use too much leverage, and this is what happened to all these clowns back here, is that all the BitMEX liquidations that occurred from people just getting too excited, just levering up way too much without enough energy. It's like trying to summit a mountain all in one day. It typically does not happen like that. So I think that this is still a good time for a straddle, to be quite honest. Either way that the price moves, as long as we don't see a big volatility crush, and the volatility has already come out of these. The volatility has already come out of the options, so there's not much left for it to go to the downside. So I don't see much risk in a straddle at this point. If you agree with me that you don't know which way the price is going to go. Now, if you think that with full certainty that the price is going to go to the upside, then playing some type of either call or vertical spread is probably a more efficient way to go. That way you're not weighed down by the cost of the other side of the straddle, which is losing money. Remember, for you to win at a straddle, you've got to have the price effectively going further than the expected move. So if you want to win at a straddle, you've either got to, by the end of June, have the price coming up into this area or down into this area. Typically, it's easier to win to the downside on the straddle because the implied volatility perks up, and that makes it easier for you to profit to the downside. Or typically what I'll do is I'll just look for a 50% return if there's an early pop. If you get a quick early pop and don't hold this into expiration, then you can do quite well from this as long as you keep your goals modest. So I keep seeing that as an opportunity going forward. Now, the big story yesterday was Ethereum. Big breakout from this, what looks to be an ascending triangle pattern, which had the upper bound at about 220, 225 or so. Nice breakout on okay volume, not great volume, but okay volume. Somebody else can tell you as to why that broke out. Myself, I just stick with the technicals. You can see that as of this morning, we have a fairly mixed market, some up, some down. Even Ripple has been doing well lately. I can't speak for this pattern. This is a very sloppy pattern that I see with a lot of other charts are looking exactly the same way. It's almost like they're overlaying each other with the same exact pattern. It's, it's kind of eerie, actually. Here's one from quite a while ago with some pretty decent volume. This is NEO, has started to lift up, as well as IoT. And once again, you can see the Bitcoin dominance has come down quite a bit over the last couple of weeks. So we're spreading the wealth out amongst the market. But as goes Bitcoin, typically goes the rest of the market. So we'll keep our eye on that one. Now, for those of you wondering how to play a straddle, it depends on when you think the breakout is going to occur. If you think it is going to come in the next 2 weeks, then probably something doing a little bit more short term would work out much better. Again, this is the sort of compromise you have with options, is that the less time that you buy, the more sensitive to movement it's going to be. You know, you could say over here, like, well, let's buy the 25 December options to make sure that we have enough time for that. Well, that's great, but you can have a really strong movement. You can have a 10% movement, and the options value of that position will barely budge. So if you buy too much time, it's going to be unresponsive. If you buy too little time, you may not have enough time to account for the move. So this is always the guessing game that you have to play. And a lot of this depends on where you consider, as we get closer and closer to the apex of this triangle where we have support levels that are getting consistently higher with higher lows, and we have resistance levels that are starting to slope down as well too. We're getting close to the apex of this triangle. So I think it's a good chance that we're going to see some type of big movement here within the next 2 weeks. You can already, based on what we said earlier this week, we've already seen some pretty big movement off the bottom of this from 8,700 all the way up to 9,700. So it's a 1,000-point move in 5 days, which, you know, let's not discount that. That's pretty significant as it is. And if we look at the energy as well, too, of this move, there's still a ton on tap. There's still a ton of energy on tap. And again, like I said, we're going to get new numbers for not only the daily, but also the weekly chart. We'll see if the weekly chart is going to continue to expand in energy. And then also tonight, we get the new monthly energies as we start to get into the new month. So to me, I think the more aggressive play is going to be the 12th June, which gives you 11 days, 19 hours. And again, the way to play the straddle is basically to find the at the money options. Right now we're at 9,600. So the at the money options are going to be approximately in this area. Let's go with a different color here. And we're going to be about 9,500. So if we look at these, again, the closer in you go, the cheaper the straddle is going to be because it's got a smaller expected move. But we're going to be spending approximately $510 for the calls and approximately about $390 for the puts. So if you were to buy a straddle on one entire full Bitcoin's worth of capital, that would be a $900 play. Fortunately, with Deribit, you can play this in 1/10 contract sizes. So you can play this for $90, or if you're using Ledger X, you can do something, you can do hundredths of a Bitcoin contract. So that would be, say, roughly $9. However, the spreads are a little bit wider in Ledger X. We can also bring this up through the Deribit position analyzer if we go out to like a 12 June. Like I said, the aggressive play is the 12 June. The more conservative play is 26 June. So if we go out to the, let's see, if we were going to buy a 9,500 put, and let's just make that one contract long. Okay, so that's a 9,500 put. And then let's add the 9,500 call, size 1, long as well too. You can see what the straddle looks like. So obviously, now these colors here, the orange line is expiration. The green line is today. So you can see that if the price moves quickly, you can very quickly get into a profitable situation for this, but it's got to be fast. It's got to be very, very violent movement, which is sort of what you're looking for from this. Otherwise, if you want to hold on all the way in there, you can see that you're going to have to get the price up to at least 10,500 for your break even. And that may not necessarily be the case if there's any volatility crush on the way back up. And as I mentioned before, to the downside, we're going to have a price movement to by expiration of at least 8,600, although it may be a little higher than that for break even if the price starts to drop, because the implied volatility will rise from that point. Of course, you can always buy the spot, right? You can always either trade futures, or you could trade the spot currency if you want to go long or short or anything like that. But what I'm trying to show you is with options, you can design a trade where if you don't know, if you're honest with yourself and you don't know what the future holds, whether it's going to pop to the upside or go to the downside, you can set up a trade where you can win regardless of which direction it goes, as long as it fits within the criteria that you're talking about, which is a relatively violent move in a short period of time over the next couple of weeks in this case. Or if you were to set this up for the 26th June, then you've got a couple more weeks past that for the price to move. I'll just close by relating to you guys that there is no perfect trade for this. There is no holy grail. Everything is a compromise, as you can see, right? So if you buy less time, it'll be a cheaper trade for you, but you got less time. But the advantage is it's going to be a lot more responsive. Or you can spend a bit more, give yourself more time, but it's going to be less responsive. So many, many compromises, which is exactly what we go through in life. So you just have to pick your poison and move forward. Hopefully you can find a setup which meets your criteria. That's it for today's report. Let's look for a big pop to the upside, make everybody happy.